and welcome back to episode 5 of Service to Savings. Today, we are talking everything taxes, and I'm really glad that I have Greg here with me today because he is a enrolled agent, which means he's allowed to not only file your taxes, but go and represent you before the IRS and IRS tax court, which is really sounds interesting to me. And let's start with Greg. Have you ever done that?
Have I called the IRS several times on the behalf of others? Absolutely. Um, it's a great value add. The representing, it's so funny. Like you think you can actually represent in front of tax court, but even EAs can't do that without taking additional courses and getting additional credentialing before the IRS. Like we obviously would be expert witnesses and stuff like that, but like there's still this beautiful line in the sand that says, "Thou shalt not practice law." But to your point, EAs are, I like to just say, like the least jargon way to do it is like tax specialists, where, we always associate our CPAs or certified public accountants as the tax experts, but there's so much more robust accounting that they do that such a small percentage of them actually does taxes. So you could talk to a CPA that's like, I don't know the first thing about taxes, but I know everything about corporate attestations and record keeping and valuations and things like that. So an enrolled agent is conferred directly by the IRS, and we focus on our taxation. So a lot of what we do here in financial planning is, I like to think that personal finance is more personal than finance, but once we get past the strategy and the values and we're talking about tactics, a lot of what we're doing is trying to minimize our lifetime taxes and optimize for certain things that allow us to live the lives that we want to live. Since tax is so prevalent in all that advice, it just made sense.
Yeah, and the way I think about it is, so I'm a CFP, not an enrolled agent. I do tax planning, meaning we look at that lifetime tax bill and kind of try and take strategies to reduce it. You're in CFP and an EA, so now you get to give tax advice that can be more tactical in the short term, right? And you still do that tax planning piece, which is the long term. Does that sound
Yep.
right? So, with that in mind, one of the first questions we have here is talking about state taxes specifically. And there's some special things for the military with state taxes. And they're asking, for their spouse, what state should they claim for state tax purposes? The spouse is from Michigan. They got married in California. The service members from Pennsylvania and currently in Connecticut. So they're like, what do we do?
Yeah, which is like all of us that have the privilege of serving our military community at least need to spend a little bit of time on this because even as a practitioner, like this is something that can easily get messed up. And a large portion of that, Joe, isn't because of the IRS or the federal government in this. It's because every state likes to do their own thing and play their own tune. But this is a massive value add that you can maybe jump through some hoops and it's annoying at first, but by doing this correctly, you can save yourself a lot of money, but you can also save yourself a lot of heartache and headache by understanding the laws and benefits that are available to you. So this is our opportunity to talk about the Military Spouses Residency Relief Act. What our active duty households have is this very unique benefit where they get to pick, at least for one spouse, what their tax return will look like. So we don't have a lot of say of where we get shipped and, what our PCS orders are going to end up looking like. And because like I've alluded to, every state has its own tax law. Under the MSRA, the spouse has choices, but and it's not unlimited, but they can claim the same state domicile as their service member spouse. So in our case study here, that would be Pennsylvania. Right. So even
Yep.
while living in Connecticut and even working, earning a wage, that spouse might actually choose to get taxed in Pennsylvania as opposed to Connecticut. And so the interesting thing here is when we move or when we PCS, just having a conversation with that knows it or doing the research ourselves, be like, okay, well, first, what are the tax rates in the state that I'm moving to? Now, Connecticut, I know off the top of my head, is anywhere between 3 and 6.9, let's call it 7%. I don't know Pennsylvania or Michigan off the top of my head, but first things first, like, well, maybe this new state has a lower tax than I am, or my tax could be ignored if for one reason or another, or maybe that state doesn't even have an income tax, right? Like some of the places down south, like if we go to North Carolina or Florida, on orders, right? There's that opportunity where my spouse can earn. And even though she's now working in Connecticut, if our spouse, like my service member spouse is from a state that has these great tax laws, and we move to this state that doesn't have great tax laws, I can choose to say, well, you know what? We're going to say our domicile and our residency is this new state. I just use two words actually that I want to spend some time on. Residency and domicile are super important. So we actually have to establish residency is really the driving factor, not just where we happen to be located, which is the domicile. But and from a back to the planning perspective, if I'm gonna arbitrarily assign 3% to Pennsylvania.
That's actually what it is for Pennsylvania, and it's 4.25 for Michigan.
Okay,
So yeah,
cool. So that actually works, right? So now we know. Let's I'm gonna say, because I said Connecticut's between 3 and six point
6.
nine nine seven, I'm gonna call it 6%. So if I'm getting orders to actually, and I had orders to Groton, I'm going to work on the submarine base, and my spouse is originally from Michigan, where she was paying 4.25, but we're married now, and throughout my military career, I've retained my Pennsylvania residency. Well, Pennsylvania treats military pay very kindly.
Yes.
And so I don't have to worry about my income getting taxed in Connecticut because I'm active duty and I'm a resident of Pennsylvania. But my wife, she's earning income in this state. But because of the Relief Act, we can say, you know what, she is only here, and I'm choosing she because it's me speaking. They are only here because I got orders to be here. And that is an important consideration, right? It's not just like, oh, I'm just going to pick and choose what state I'm in. You actually have to be able to justify, well, why are you here making money? So now she gets a job in Connecticut earning money. Now she will have to file like a non-resident tax return saying, hey, can I earn this money, but I'm paying tax and I'm a resident of this other state. And oftentimes you'll get that credit, so you're not being double taxed. And now
Right.
Pennsylvania will say, well, you don't actually, you can pay what I say, 3% versus
3%.
6%. Well, now you're saving that much more money on your income. So bringing this full circle, when we PCS and our spouses decide to work, it's important just to get familiar with your local tax laws because we have this opportunity to save some money there. What do you think, Joe?
I think that's great. The only thing that I would add to that is now if we throw children into the mix and you're
Mhm.
saving in a 529, if you had your spouse as the person who is contributing to the 529, you want to look at the state they're going to claim and how much they can deduct. In Pennsylvania, I think it's 19 grand or yeah, $19,000 a year per beneficiary that they could contribute to a 529 for college funds. And remember, that money only needs to stay in there for one day, right, to get that tax benefit. So if you have $19,000 in college expenses, run it through a 529, and now that's $19,000 less that you have to pay state income tax on for that year. Right.
Mhm.
So, and I don't know what it is in Connecticut. I know Rhode Island because we both happen to be located there. It's $500 a year. Right. And so
Yeah,
it's
we did
kind of
a
laughable.
thousand married filing jointly. Yes.
Yes. Doing that, like that's a lot of money to save taxes on, right? And all of a sudden you've got a really good deal there. So, those are kind of the things that, you want to look at.
Mhm.
What's the tax rate in the state that you're domiciled in, where you're currently at? What's the tax rate in your historic state, in your wife's historic state? And then you want to, and from there you want to make the decision. The best thing is all of your wife's jobs get to count in that state, right? Which is actually better than the military member. Because the military member, if you have a side hustle, you have to pay taxes in the state that you're currently in. So in some ways, they actually have it better than the active duty members.
Yeah. One thing that, and it's funny that you said that. I know a lot of service members that have side hustles, but I remember in my like right out of boot camp days thinking like, what a nightmare that must be because like they beat into us that, oh, you have to ask permission to do anything. And
Yeah,
I'm like, well, I'm just not gonna, I'll just work here and I'll get paid tuppence because I was, super junior enlisted at that time and just hope for the best.
yeah,
Completely tangential. Yeah. So to your point with, I mean, there's actually a few things like, so your dependent care FSA strategy or flexible spending account strategy, that's another good one to consider if you have kids. Some of the junior enlisted might actually be even looking at trying to manage their earned income tax credit eligibility, but digging more into the 529, some of the things I heard you say is certain home state tax benefits might outweigh others. So some states don't offer any tax deduction for
right.
529 contributions, which is crazy. I mean, it's not crazy. It's just unfortunate, right? Whereas some have really great plans. Utah's plan is always good. Nevada's plan's pretty good. I don't really like Virginia's plan. I have mixed feelings about, but there's some good plans out there. So taking into account state 529 benefit flexibility there is pretty huge.
Yeah. And some of them will even let you contribute over whatever their yearly maximum is and carry the excess forward into future years, which is
Mhm.
kind of awesome too, right? There was somewhere that I was looking at recently that they'd let you carry over up to 10 years of future contributions. I think it was 10,000 a year. So you could carry forward up to 100,000
Yeah,
and deduct it off the 10 future years of income, which again, if you got that big college bill or even grade school or secondary school that you're paying tuition for, you can run that money through a 529 and withdraw it each year.
yeah. Which is huge. Just one thing on home states and well, which one do you pick? I think, and I don't know if this is like a behavioral, like it's the feeling thing, but I would say don't feel locked into your home state. And maybe I don't have anything to back this up, but I feel like, hey, well, that's where I came from. Like that's part of like who I am, my identity. But at the end of the day, there are times to optimize. Like you can always choose to go back there, but at the time of my election, hey, I might get orders to a state that's great. And as long as I can say, well, no, I think this is my state now. Like this is where I'm going to end up when I'm not. That can become my residency state. I don't have to keep. In my case, it was Massachusetts when I enlisted that home of record. Just
And
something
it
to
can make a huge difference, right? Get stationed in Alaska, and I know it changes year to year, and I'm not 100% up to date on what it is, but there's some years where they pay you to be a resident of Alaska, right? You don't get
Mhm.
taxed; they cut you a check, and you got to spend so many days in the state. Service members I knew that would take their annual leave and go up there so that they got the check, and the whole trip was paid for by their check from the state, right? So, and they like that each year.
Yeah, absolutely. Done.
So, staying on the topic of taxes now, but shifting a little bit, rental houses. So, someone's asking, do they need to take the depreciation on it? And what really happens with their capital gains exclusion, if they sell it later on while they're still on active duty? So, to start out with, give a little background. If you live in a house for 3 out of the 5 last years under normal conditions, you get to exclude up to $250,000 for a single person or $500,000 for a married couple from capital gains on that house, meaning the house is worth more now. You sell it, you don't have to pay taxes on it, federal taxes on it. So, do you want to? I know you're a rental house owner, so do you want to talk about the depreciation and that capital gains exclusion?
Yeah. So depreciation's the gift that keeps on giving. I actually saw on LinkedIn today a really interesting graphic or table, and it had like return on investment on one axis and return on hassle on the other. And it's like all these different ways that we can build wealth. And I meet so many people that absolutely love and are enamored by rental properties and quote unquote passive income. Even I'm like the guy that's like throwing rocks at my glass house here because I have rental property and I'm just like, it's the dumbest income that you can come up with. Like it's such a pain in the ass unless you love it, part of my language. But like there's nothing passive about it. Every time I'm in Florida in July or June, that's when the tenant calls and says something broke. So now I'm calling a technician. I can't even go over and see it myself. Like, and then you can always hire somebody to do all that stuff and manage your properties. But again, that whittles away at that income that you are in love with. But to answer your questions, so we have to take depreciation. IRS will, once it becomes a rental property, it's not a really a personal asset anymore. It's a business. And it's what we're doing is we're actually getting some of what we paid for this business back year over year over what is considered the useful life. Now, how does that pay into the capital gains exclusion? I'll get to that in a second. First, the military gets an extended exclusion. So, as you said, Joe, if you've lived in this house a minimum of 2 years or 3 years of the last five, a married filing jointly household can exclude up to $5,000 of the capital gains. Just because this is jargon laden, I just want to say your capital gain is just the difference between what you sold it for less what you've paid for it and put into it. So we call that basis. But if I bought a house for 500,000 and then I put in improvements of 100,000 and then sold it for a million, right? Whatever's that cream, that difference of what it earned above what I put into it, that's what we're
Yep.
talking about for capital gains. And there's different types, long term, short term, and it's really based on, did you hold it for 366 days or did you hold it for less? But that's neither here nor there. The military gets this extension under the Internal Revenue Code 121D something. And active duty service members can suspend their 5-year test period for up to 10 years while they're on qualified official extended duty, like so stationed at least 50 miles from that home or required to live in government housing. Does that sound right to you, Joe? I think that's
Yep. That sounds right. Yep.
correctly. What this means is, the normal window is if you want that extension, you sell within 5 years of moving out. Because like if you cross over into 6 years or 7 years, right, then there's that possibility that you didn't meet the minimum year requirement. The military
Right.
extension says, hey, I get 15 years because I get that 5-year blade base plus that 10-year suspension. You still have to meet the 2-year ownership and use requirement, but because we are like to move, we get a break. What that looks like in terms of a timeline, I would say, let's say in 2020, I buy a house in Connecticut and I live there as my primary residence. 22, we're going to PCS down to Goose Creek, South Carolina, just so we're keeping score. That's after 2 years of residency, right? So I've checked that
Yep.
box. And in 2024, I can convert that to a rental property. 2035, I can still sell and claim the exclusion with the window. But that's going to be my fancy segue into our depreciation issues. So the suspension of the 5-year test, I still met my 2-year requirement, and it has to happen before you turn it into a rental property. But because I'm on orders down to Goose Creek, I get that exclusion. So every year that I'm turning it into a business, I'm depreciating. So that means I just get this. There's a table that says, hey, the useful life of this asset equals 27 and a half years because it's a residential property. And the amount of its value of that basis will come to me each year as a deduction. So my expenses are lowered. I get to keep a little bit more of that income or pay a little bit less tax, I guess, on that rental income. If I sell this pretty much anytime after 1996 or 97 or something like that, there's a good chance I'm going to owe what's called depreciation recapture at about 25% of all the depreciation I took on that property. And unfortunately, we don't get to avoid that even if we're using that exclusion or that extension of the exclusion.
Where that's important and where that 25% comes from, and correct me if I'm wrong here, Greg, is essentially what they're doing is they're saying, okay, you excluded $20,000 in income from being taxed. We're going to assume your tax rate was 25% of that. And so now you owe that back in taxes because you should have paid that initially.
Hmm. Yeah, that's how I kind of justify it and reconcile that in my head. And I mean, the reason why we're bringing it up and why I'm bringing it up, this recapture caveat up, is because this is a good way to kind of shoot yourself in the foot, not anticipating this when we're
Yeah.
making the sale. So it's low hanging fruit to be prepared for this, but I see it time and again that it surprises us.
Yeah, this is where I think having either a good real estate agent that will do these calculations for you and tell you what this is and be aware of it. 'Cause you'd be surprised how many real estate agents don't realize even capital gains. If you go over 500,000, you owe federal income tax on it, or things like that. So a good real estate agent should be able to answer these questions for you. And if not, paying for an hour of a financial planner's time to go, hey, here's all the figures on this. Can you calculate like what I'm going to owe, or, especially one that's an EA should be able to tell you like, here's what we think you're going to owe, and be ready for that. Because the last thing you want to do is go to closing, expect that you're going to clear $400,000 on this house, and then find out, oops, it's really only 300,000 because I owe $100,000 in taxes. Or even worse, you spend all 400,000 and it comes tax time in April, and you're like, you need to
Oh
come
no.
up with $100,000, right?
And it's funny because a little bit of like even like me, I'm like, oh look, squirrel. A little bit of organization, a little bit of process or systems can absolutely pay dividends. And this is a great example. Tracking your depreciation accurately is huge. Tracking the improvements and the income they put in. Now, the IRS really wants you to keep receipts for everything. And luckily, with digital copies, it's a little bit easier, but really just good record keeping in your finances. It's a salve that solves a lot of issues.
And I think this really speaks to one of the real long-term powers of having a financial planner that you work with is that ongoing relationship because they can help build that organization in for you. Like, oh, yeah, like I've kept a copy of your tax returns for the last 10 years,
Uh-huh.
that we've worked together. And I have depreciation for that rental house for every year for that 10 years. Right. So I, I think it really helps out a lot.
I agree.
So just to sum up there, yes, you need to take depreciation. Just to let you know, if you don't, the IRS doesn't care. They still get to recapture it. So if the way it's worded in the tax code, I believe, is depreciation taken or entitled to. And so if you don't take it, you still have to pay the recapture. So be aware that if your tax specialist is not doing depreciation for you, find a new tax specialist. And then, when you look at that, capital gains exclusion, especially if you separate from the service, make sure that you read the rules well because they get a little complicated there. But, the basics of it are if you're not on active duty, it's 3 of the last 5, right? And then if you are on active duty, they kind of suspend that 5-year window for you for up to, what is it, up to 5 additional years? Is it, Greg?
So it's up to 15 years total because you get the
Okay.
10-year, up to 10 years while you're on qualified extended duty stationed at least 50 miles.
Okay. So that's right. So it's an additional 10 years essentially. And you just can't be stationed in the area. If you get stationed back in the area, you move back, but just know that that also creates a
Yeah.
headache for you. Uh, so, with that in mind, subscribe for more exclusive content and updates designed for military life. Because building lasting wealth with strategies from Military Financial Advisors Association will help alleviate these headaches. As your career progresses and success brings complexity to your finances, whether through rental property, choosing the right state of residency, or where to file your taxes at. Working with an MFAA advisor can help you navigate that complexity. Visit militaryfinancialadvisors.org to get started. Thanks for listening. Make sure you subscribe, and please, a 5-star rating would go a long way to helping out our podcast, and we'll see you next episode.
The information provided on Service to Savings, the Military Financial Advisors Association's podcast, is for general informational and educational purposes only. Nothing contained in this podcast should be construed as financial, investment, legal, or tax advice, nor is it intended to be an endorsement or recommendation of any specific product, service, or investment strategy. Always consult with a certified financial planning professional, preferably an MFAA member, before making any financial decisions, as your personal circumstances, including military benefits, TSP contributions, deployment-related finances, or retirement planning may require tailored advice.